Welcome to the final lesson of Chapter 4, Tracing the Roots and Growth of Retail Forex Trading. We begin our journey in the 1970s when the retail forex market was in its infancy. In the early days, the world operated under the Bretton Woods system, a monetary management setup established in the mid-20th century. It was a time when exchange rates were fixed and tied to the value of gold. Under Bretton Woods, the world's currencies were pegged to the US dollar, which was in turn linked to gold. This system was designed to promote monetary stability and foster economic growth. However, by the 70s, the Bretton Woods system began to crumble. Economic conditions had changed, and the gold standard was no longer viable. Countries faced the pressure of inflation and a lack of gold reserves. The system was unable to adapt to these shifting economic landscapes, prompting world leaders to seek a new approach. In 1971, U.S. President Richard Nixon announced the end of the U.S. dollar's convertibility to gold, marking the collapse of the Bretton Woods system. This was a monumental shift, and it ushered in a new era of free-floating exchange rates. In this new system, exchange rates fluctuated based on supply and demand in the market. The end of fixed exchange rates and the birth of flexible rates brought about a significant change in the foreign exchange market. The Forex market as we know it today began to take shape. This shift opened up opportunities for speculation and trading on price movements, paving the way for the emergence of retail forex trading. However, the road to a mature retail forex market was not smooth. The transition was marked by numerous challenges and obstacles, which we will explore in the next segment. As we moved into a new era of free-floating exchange rates, the stage was set for the birth of retail forex trading. Join us in the next scene as we delve into the challenges encountered by individual traders in these early days. In the early days, forex trading was not a walk in the park for individual traders. The world of forex was like a towering fortress, seemingly impenetrable to those who lacked the substantial capital or the right connections. The first hurdle was the high capital requirements. The forex market was, to put it bluntly, a rich man's game. Trading currencies required significant upfront investment, often to the tune of tens of thousands of dollars. This barrier to entry rendered the market inaccessible to most individual traders. Then there was the matter of limited access to market information. In the age before the internet, real-time information was the exclusive privilege of the big players, banks, hedge funds, and multinational corporations. Individual traders were often left in the dark, making decisions based on outdated information. This lack of timely data added another layer of risk to an already risky endeavor. And let's not forget about the complex trading infrastructure. Trading currencies wasn't as simple as buying low and selling high. It involved navigating a labyrinth of exchange rates, understanding intricate financial instruments, and keeping abreast of global economic trends. To say the least, it was daunting for the uninitiated. These challenges combined to create a market that was, in many ways, rigged against the individual trader. High capital requirements kept the doors of the forex market firmly shut for most. Limited access to information meant that those who did manage to get in were often flying blind. And the complex trading infrastructure meant that even those who had the capital and the information often found themselves lost in a sea of numbers and economic jargon. But here's the thing about challenges. They're meant to be overcome. And that's exactly what happened in the world of forex trading. While these challenges were daunting, they did not deter the determined. The forex market was about to undergo a revolution. In the 1990s, technology and the internet changed the game for forex trading. Imagine a time when trading foreign currencies was a privilege reserved for large financial institutions and well-heeled investors. Then, in the 1990s, a revolution happened. You know those chunky buzzing boxes we used to call computers? Well, they got smarter, faster, and more powerful. And with the advent of the internet, they became portals to a new world of opportunity. Suddenly, individual traders had access to global markets right at their fingertips. The realm of forex trading, once shrouded in mystery and complexity, became more transparent. Real-time data, once the exclusive domain of high-flying financiers, was now available to anyone with an internet connection. Prices, trends, analysis, all there for the taking. And that's not all. The rise of the internet also brought about the development of online trading platforms. These platforms allowed traders to interact directly with the forex market, bypassing the traditional broker-dealer model. This meant lower transaction costs, faster execution times, and the ability to trade on live market prices. But perhaps the most significant impact of these technological advancements was the democratization of Forex trading. With the barriers of high capital requirements and limited access to information broken down, Forex trading was no longer a game for the elite. Anyone, regardless of their financial status or geographical location, could participate in the global currency exchange market. The technological revolution of the 1990s didn't just change Forex trading, it transformed it completely. It made it accessible, it made it transparent, and most importantly, it made it possible for individual traders to compete on a level playing field with the big players in the industry. So the next time you log into your trading platform, take a moment to appreciate the power of technology. It's more than just a tool. It's a bridge that connects you to a world of opportunity, a world where the only limit is your ambition. With technology bridging the gap, retail forex trading was ready to take off. The rise of brokers catering to retail traders marked a significant milestone in the evolution of forex trading. This shift was instrumental in opening the doors of forex trading to an entirely new breed of traders. In the early days, the forex market was an exclusive playground for large financial institutions and multinational corporations. The high capital requirements and complex trading infrastructure made it nearly impossible for individual traders to partake in the action. But as the 80s rolled into the 90s, a change was on the horizon. This change came in the form of retail forex brokers. These brokers emerged as a response to the growing demand from individual traders who wanted to tap into the lucrative forex market. Offering smaller transaction sizes, retail forex brokers made it possible for anyone to trade, regardless of their financial capacity. But it wasn't just the smaller transaction sizes that reshaped the landscape. Retail forex brokers also introduced more user-friendly trading platforms, making the process of trading less intimidating and more accessible. These platforms provided a host of tools and resources like real-time price charts, technical analysis tools, and economic calendars to assist traders in making informed decisions. With these advancements, the forex market was no longer a closed-off arena for the elite. It became a globally accessible platform where anyone with a computer, an internet connection, and a little bit of capital could participate. Retail brokers played a crucial role in this democratization of forex trading. They brought the market to the masses, making it possible for everyday individuals to trade currencies from the comfort of their own homes. But it wasn't all smooth sailing. The emergence of retail forex brokers also brought about new challenges, like the need for regulation and trader protection, which we'll delve into in the next scene. For now, let's take a moment to appreciate the transformation brought about by retail forex brokers. These brokers transformed the market, making forex trading accessible to the masses. From the birth of retail forex brokers to the present day, forex trading has never been the same, and it's only getting better. As the retail forex market grew, the need for regulation and trader protection became paramount. As with any financial market, the forex market carries inherent risks. However, it's the job of regulatory bodies to minimize these risks and ensure a fair trading environment. Let's delve into the development of these regulatory frameworks. In the initial stages, the forex market was like the Wild West, with little to no regulation. But as the market evolved, the need for rules and regulation grew. Regulatory bodies started to emerge in different parts of the world, each with its own set of rules and guidelines. These organizations, such as the Financial Conduct Authority in the United Kingdom, the Commodity Futures Trading Commission in the United States, and the Australian Securities and Investments Commission, to name a few, were established to oversee the forex market. They ensure that brokers and other market participants adhere to a set of fair trading practices. The regulations put in place by these bodies serve several key purposes. First, they ensure transparency, meaning that all market participants have access to the same information and prices. Second, they promote fair trading practices by enforcing rules against market manipulation and other unethical practices. Third, they protect traders' funds by requiring brokers to adhere to strict financial standards, including maintaining sufficient capital and segregating client funds. Moreover, many regulatory bodies have established compensation schemes to protect traders in the event of broker bankruptcy. This means that if your broker goes under, your losses would be covered up to a certain amount. The implementation of these regulations and protective measures has greatly increased the safety and integrity of the forex market. They've created a level playing field, where individual retail traders can trade with confidence, knowing their interests are safeguarded. In essence, these regulatory frameworks are the guardians of the Forex market, ensuring it operates with integrity, fairness, and transparency. They've been instrumental in the growth of retail Forex trading, making it not just accessible, but also safe for individual traders. With these protective measures in place, retail Forex trading became a safer environment for individual traders. From a niche market to a widely accessible one, retail Forex trading has come a long way. It's been a journey marked by significant milestones, each shaping the landscape of this dynamic market. Let's take a moment to reflect on this evolution and consider what lies ahead. In its infancy, Forex trading was largely the domain of large financial institutions and professional traders. The transition from the Bretton Woods system's fixed exchange rates to a free-floating currency system in the 70s opened up new possibilities. But the path was not without its challenges. High capital requirements, limited access to market information, and a complex trading infrastructure posed significant hurdles for individual traders. However, the advent of the internet and advancements in technology in the 90s revolutionized Forex trading. Information became more accessible, transaction costs reduced, and trading platforms evolved to become more user-friendly. This democratization of Forex trading paved the way for the emergence of Retail Forex Brokers, who catered to individual traders, offering smaller transaction sizes and more intuitive platforms. Amidst this rapid growth, the need for regulation and trader protection became increasingly apparent. Regulatory frameworks were established to promote fair trading practices and safeguard the interests of traders. These measures have played a crucial role in instilling confidence in the market and encouraging participation from a wider audience. Looking ahead, the future of retail Forex trading is likely to be shaped by further technological and regulatory changes. Developments in artificial intelligence, blockchain technology, and machine learning hold exciting potential for enhancing trading strategies and risk management. Simultaneously, regulatory frameworks will continue to evolve to ensure the market remains fair, transparent, and secure. From a fledgling market in the 70s to a vibrant and accessible platform today, the journey of retail Forex trading is a testament to the resilience and adaptability of traders and the industry as a whole. As we continue to navigate the Forex market, one thing is certain: the journey is far from over. This journey into the world of Forex has been enlightening, hasn't it? We've traveled from the early days, tracing the roots of retail Forex trading back to the 1970s, through the transition from the Bretton Woods system's fixed exchange rates to a free-floating currency system. We've navigated the initial challenges for individual traders, explored the revolutionary impact of technological advancements, and witnessed the emergence of retail Forex brokers. Consider how far we've come, from high capital requirements and limited access to market information, to today's user-friendly trading platforms and protective regulatory frameworks. The evolution of Forex trading from a niche market to a widely accessible one has been truly remarkable. Now, it's time to consolidate your knowledge. Complete the final lesson of this chapter, absorb the insights, and take the leap. Don't forget to take the quiz, Who Trades Forex, and get ready to start Chapter 5. Understanding the advantages of Forex trading. Until next time, keep learning and keep trading.